Okay guys, good evening and welcome to tonight's webinar hosted by FP Markets and presented by Shawn Lee of FXWW. For those of you that don't know, FP Markets is an Australian-owned and ASIC-regulated broker with over 12 years experience and 34 industry awards. We facilitate trading in equities, indices, commodities, futures, Forex, and more recently Bitcoin via our MetaTrader 4 platform. I'll now hand you over to Shawn, who will provide you with an insight into the performance metrics of a successful trader. Thanks, guys. Enjoy.
Good morning, good afternoon, and good evening, everybody, wherever you may be. Thank you very much for joining us in what I hope should be a very informative and interesting webinar. And so again, just to introduce myself, my name is Shawn Lee from FXWW. Our business is built around finding the next generation of professional FX traders primarily, or what we call global macro traders generally. And we believe that we are going to find this talent in the retail space, as there is nowhere else to find it really, because the banks have stopped training traders. So there's a lot of opportunities that exist in both the institutional and the retail spaces. And I'm going to give you my opinion on what sort of performance parameters you need in order to attract either investment or to get a job, whichever way you want to go. And yeah, so let's get straight into it. So we're going to start with a few definitions now. For the purposes of this webinar, I'm differentiating between a fund manager type and a prop trader type. Now, the fund manager type, look at literally, I've written it out here. So usually manages large allocations from institutional investors with a mandate to beat other classes whilst providing a hedge or uncorrelated return. Typically speaking, they are less active traders. They could be multi-manager traders. Their returns will be more, the volatility of returns will be low. So they're not taking very high risk. So a different profile from a fund manager to a typical prop trader. Now, the prop trader is somebody who chases returns. They have a skill level which enables them to maximize profits and minimize losses. And they're highly sought after. It's a much more, I would say, a more difficult job than the fund manager, more exhausting anyway, and more time consuming. And oftentimes prop traders are hired by fund managers to be part of a fund-of-fund setup or the like, or they simply are hired by high net worth individuals, or they work under sort of managed account. They run sort of managed account systems, etc. So there's various ways that a prop trader can raise assets under management. So they're the two types of traders we're going to talk about. Just briefly about some of the other definitions. Drawdown, most of you are familiar with this word. It's simply another word for loss. But very important that drawdown includes both realized and unrealized losses. And it seems that I've come across a lot of traders in the retail space who are telling me that they've made 50% profit, and yet they've got 60% unrealized losses sitting elsewhere, and they say that doesn't matter because it's not realized yet. It absolutely does matter. So a drawdown includes both realized and unrealized losses. Peak to trough drawdown. Again, we'll have a look at. Actually, I'll show you a little picture if you just bear with me a second, and this is what a peak to trough drawdown looks like. So over here we've had, obviously on the left hand side, so the equities or the amount of capital in the account has been going up, and suddenly we hit a ceiling and went into a drawdown period. So this could have gone for a day or a week or a month. hopefully not any more than a year. But every trader at some time or another will have a drawdown period, and it will at some stage then stop. Either you stop trading or the drawdown stops and starts to reverse. And then once you get back up to this peak again, and then your recovery time is then over, and that's what's called the recovery time, the distance between the initial peak and then getting back up to that level. So that's the sorry, bear with me. That's the peak to trough drawdown. So the biggest percentage loss, the recovery time we looked at, and notional value. Now, notional value is something we're going to have a very sort of hard look at today, because for most retail traders, it's very, very, very important. What you trade, the size of capital or the amount of capital in your account is not necessarily the most important issue. What's important is the amount of capital that's at risk. Or in this case, we've looked at the total value of leveraged positions. So this is a very, very important concept to understand. We will look at a few examples shortly, which will, I hope, clarify that and explain to you the importance of a notional value. So let's move on, and we're first and foremost we're going to look at the institutional investors. Now, I'm going to jump the gun a little bit and say that most people who are listening to this webinar are probably not ready to introduce themselves to institutional investors. For a number of reasons. So firstly, there's very, very, very strict due diligence carried out by the investor. Now, these investors could be asset managers, hedge funds, banks to some degree, though they probably haven't been investing for the last sort of 10 years or so. But yeah, any big institution, family office and the like, and they're good at what they do. They're good at investing, and they're very, very, very careful. So they carry out a very strict due diligence. I believe possibly in the next slide, actually I'll skip back, but in the next slide we're going to look at some of those important boxes that have to be ticked. So if you get past that stage and you tick all of the boxes, then you will get an allocation via a fund structure or a managed account. Many hedge funds and asset managers, due to their constitutions and their setups, can only allocate money via fund structures. Or that was certainly the case in the past, but it has changed quite a lot with the advent of more secure managed accounts, segregated accounts and the like. So at the moment, it's either or. You can get an allocation via a fund structure or a managed account. You will almost certainly, if you are a hired hand, if you like, or a contracted trader, you will need regulatory cover. So if you're not an employee of the asset manager or the hedge fund, then you will be required to have a wholesale license. Now, this is much easier to acquire than a retail license, but it still needs to be done. So I'm not sure what it costs in various jurisdictions, but I think, down here in Australia, it may cost you sort of $25,000 or $30,000 to get a license. So it's certainly not a cheap exercise. Now, the institutional investor will generally focus more on consistency rather than chasing after really, really high returns. And we're going to look at those parameters in more detail shortly. Sorry, bear with me. We're just doing a little bit of technical work here. Yeah, we're moving on. Good. So as I said, focus generally is on consistency rather than high risk returns. Now, that can change somewhat as if it's a fund of funds type investor who occasionally will have slots where they look for high risk traders, but generally speaking, these institutional investors focus on consistency. And as I said, we will have a look at those details shortly. And then how do you get paid? In this case, you'll get paid a management fee and a performance fee. So the old sort of a standard payment structure was 2 and 20. So a 2% management fee and a 20% performance fee. So if you're good, I think though you can still command that sort of those sort of fees. And when you think about it, a lot of the big institutional investors, their minimum allocation is $10 million. So they do not allocate any less than $10 million. So if you get a $10 million allocation, the management fee alone, you've got a 200 grand base salary, and then you can make some pretty decent performance fees on the back of that. So shortly we'll go and have a look at what you need to be able to show that institutional investor in order to attract these type of funds. So now on to the boring bit, which is the due diligence. And I believe it used to be the famous 64 boxes. You had to tick 64 boxes. Now we're only looking here at some very, very general areas that you'd have to cover. Obviously, general business information. So what is your business? Are you a sole trader? Are you a company? What's the setup? Who are the shareholders, etc., etc. What is the investment strategy? Now this, I'm always amazed at how difficult people find it to actually write down coherently in a relatively short space of time what they do. I've seen traders with 30 years of experience trading sort of big volumes, and for every day of the year almost for 30 years, and then you sit down with them and you say, okay, can you please just explain to me what you do? And they really struggle to do so. They hum and they haw and they say, oh, I do a bit of this and maybe a bit of that. And that's not a lot of help if you're sitting across from an investor who wants to understand what it is you do. So it will become very important as you move on to a stage where you want to promote yourself to potential investors, that you can explain in 400 words or less what you do. Now, you can't, obviously there's going to be more in-depth and long-winded descriptions of what you do to come later, but as part of your initial pitch to somebody, you need to be able to explain your investment strategy coherently and succinctly, and I would say in 400 words. And that included in that is the your risk management process as well, included as part of that. Following on from that, presuming the investor's happy with that, then what's the investment process? So if I want to give you some money, I've got $2.2 million to give to you. How's that going to be? How's it going to be managed? Is it a managed account? Is it a fund? Are they segregated accounts, etc., etc.? Now, most investors will have their own processes set up, and you will have to adapt accordingly. But in some cases, they may say to you, okay, how's this going to work? The management and trading team. So are you a sole trader, or is there more than one? Who are the key people? If Joe Smith gets hit by a bus, what happens? If the IT guy gets, struck by lightning, what happens then? So it's very important to be able to explain who the management, the trading team are, and what the backup's like. Market environment, really that's just about your the markets that you trade and the types of situations that you like to operate in. The investment terms, what are the fees? What are the drawdown? When do you stop trading? All the rules associated with the investment account. Governance and compliance, very important these days. Almost everybody now has to have some form of reporting structure. Of course, your track record, and then almost daily reporting, accounting, administration, etc. So they're just some very broad sections that you are going to have to be able to answer to when the investor comes along. They're going to want some information on that. As I said, so that's primarily for institutional investors, obviously a different situation when we come to retail, but let's move on to that next. So due diligence, very important. So here we go to the retail investors. Less focus on due diligence for sure, but becoming more so, and I think that's a good thing. We don't need to have 64 boxes to tick, but certainly it's good that the retail investor at least should see who you are, not one of these pseudonyms or a sort of some random system. And I think so the retail investors are becoming more and more savvy. Of course, you've got the small accounts. There's always people chasing after a lucky win, etc., etc. But that's not what I'm talking about here. I'm talking about if you're traders who are trying to build a business for themselves, starting in the retail space, and they're trying to attract pretty savvy investors who are probably more willing to take on a little bit of risk, and are more likely to see through a few swings and roundabouts, ups and downs, and are also probably less likely to ask for all of those boxes to be ticked. Now, these accounts usually happen in the form of managed accounts. I'm sure most of you are familiar, particularly on the MT4 platforms, with the MAM type structures. So it's relatively easy to set up, and they're available now. I know other, like Interactive Brokers and other brokers, etc., have offer the same type structure. So relatively common now. But managed accounts are certainly licensable. I think in most jurisdictions, you're required to have some regulatory cover if you are offering a managed account structure. Copy trading up to date has been like a gray area, and none has not required any regulatory cover. I believe, I may be slightly wrong on this, but I believe the FCA in London, as of January with the MiFID II, et cetera, that copy trading has now come under sort of the managed account type. So it's basically the same, treated the same. So it may well be that in the UK particularly, you're required to be licensed for copy trading, but it's still seen as a grey area everywhere else. And I think most traders are able to offer a copy trading service to at least to certain investors. Now these investors generally focus on higher returns. They're not after the steady 0.4% per month is not necessarily what they're after. They're looking for a little bit of excitement, and they're chasing their most of their money tends to be at risk, and they're happy to take on a bit more risk. And you as the trader are likely to be paid primarily a performance fee. So there will very seldom be a management fee in these cases. More likely you're going to be paid a 25 to 30% performance fee. I know there are some traders out there trying to charge a 50% performance fee, and well, look at if they can get it, good luck. But I certainly wouldn't be paying anything like that. It's the investor who's taking on the risk. So 25 to 30% performance fee. Now, quickly, I'll just touch on the types of employers who are out there. Like you see them listed there: hedge funds, prop desks, banks, fund of funds, and HNWs, that's high net worth individuals, and family offices. And they will often hire prop traders, less often fund managers, I think, but more often they'll hire prop traders who present the right picture. And we're going to have a look at very shortly what that picture looks like. As a retail trader, if you want to turn up either for a job or an allocation from one of these asset managers, hedge funds, prop desks, etc., what are you going to need to be able to show in order to get that allocation? So let's move on. That's the important part. Well, actually, before we get there, we're now going to look at the fund manager. So you've decided you want to be a fund manager, and you want to attract institutional funds. So these are your requirements. Now, I'm not going to spend a lot of time on this because I believe very few of the people listening to this webinar will tick these boxes. So but if you wish to attract funds as a fund manager from an institutional client, you will need to be licensed. You would require probably at least $10 million assets under management. You would need a 2-year audited track record, and that's audited by one of the well-known accounting firms, and that's going to cost you 25 grand a year, probably, just to get that audit done. You will have annualized returns of around about 5%, 5 to 7%, I would suggest, and you are well ahead of the game as a fund manager. So let's think about that just for a second. Rather than if you feel that you are the type who is more likely to develop into a fund manager rather than a prop trader. And this is a longer, it's going to take you a longer time, it's going to be drawn out a bit. But this is what you need to be aiming towards: annualized returns of 5 to 7%. Doesn't sound like much, 0.5% per month. It's not a lot when you've got, a 20 grand account. But if you've got a, $14 billion account, then it's it's a bit more interesting. So that's what you should be aiming towards as a fund manager. Annualized returns of 5 to 7%, monthly drawdowns of less than 1.5. Now I've just, I've sort of taken a little bit of liberty here and just, there is no book on this, no set of rules. So I'm just giving you rough indications of what, in my experience, fund managers like to show. So that monthly drawdown, less than 1.5%, probably quite a bit less than 1.5%, peak to trough drawdown of less than 6, and recovery time of less than 6 months. And by the way, just in case there's anybody listening to this who does actually tick all of those boxes, please go and find my website at FXWW and fill out the Premier Traders form, because I'd love to meet you. So yeah, if you are out there, but it's more likely that we're going to have to create you, find the right person and help them to get on that path to being a fund manager. But I think most people here are going to be interested in the prop trader directions, and very important here, we're going to spend a bit of time looking at some notional examples of notional returns, because that's going to be very important. So a verifiable 12-month track record, for most people that should be achievable. So anybody who's, if you've only been trading for 3 months, well, you're just looking, you're probably way too early looking to get funded somewhere. Most people will have been trading 3 to 5 years already. They've probably made quite a few mistakes, which is what investors like. Investors like to see people making mistakes with their own money. They don't like to see the trader making mistakes with their money. So what they like to see is, a trader who's had maybe 3 years of, there might have been some losses, some chopping around, generally up and down, making their mistakes, and then they figure out what it is they do. And it can take some time. You make your mistakes and you realize that actually you're a swing trader, not a trend trader, and that you are more of a short-term trader rather than a long-term trader. Whatever it may be, it can take some time to figure out what you are. So, presuming that you've had that 3 years of, pain and learning behind, and then you go about establishing a verifiable 12-month track record. Now, like we looked earlier on the due diligence, it's very important here to know what you do, to be able to explain what you do, that is something consistent, and that that you can write that down, your investment strategy. So in other words, what do you do? Now, here we're looking at, as a prop trader, a notional monthly return of 1%. Now, I know I can already hear the guffaws and the laughs and people saying, oh, that's so easy. I do that every day. The important thing to note here is the notional, and we're going to look at that in a second. And making, $200 or whatever a month, if that's your, if you've got a small account. If you've got a 10 grand account and you're making, $200 a month, isn't that 2%? When you say, well, that's easy, I can do that any day of the week. So what about if your account is $500 million? Can you do the same thing? And there are prop traders I know who are managing generally for some of the bigger hedge funds, they are managing $500 million. That's what their allocation is. So big difference. So can you then return 1% monthly on 500 million? So in other words, can you make $5 million a month profit? It's not easy, let me tell you. Let me put it that way. Anyway, we will come back to that. In fact, I think it's the next slide. Yes, next slide. We'll have a look at the notional, which is going to be very important for any retail trader with his own retail account. So monthly return 1% per average. If you can show that typically to and consistently to an employer or investor, they're going to be interested straight away. Biggest monthly drawdown. I've put the number at 3.5%. Some investors are more lenient because they know the trader is capable of delivering bigger returns. But on average, I would say keep your monthly drawdowns below 3.5%, and that's going to make the decision for the investor much easier. And I think that's what we're after here. We're not, we're trying to make things as easy as possible for you to get that initial allocation from an investor. So I would suggest keeping, once you're on this run of establishing your core track record and you know what it is you do and you're on your path, then keep those monthly drawdowns below 3.5%. So here's my rant for the day. I'm going to go on a little bit of a tangent here, and this is my pet hate in the investment space, is the fact that we are tied to monthly and quarterly and annual returns, and it's just the way it is. Because anybody who's traded will know, you come to the 31st of the month, and it's coming up to the end of trade in New York, and you're really on a big trade, and it's going well, and you're adding to the trade, and everything's just happening great. But simply because it's the end of the month, end of one month and the start of the next month, you have to be very careful what you do just at that moment in time. Because if you just, once the 5 p.m. hits in New York at the end of that particular month, and your monthly number is then set in stone, I don't care if you're up, you could be up 8% for the month, and it looks magnificent. But then on the first day of the next month, you give back 3% because it was just a natural swing. And that just shows up very poorly in your monthly data. And look at it's really, I think it's unfortunate. And I know some investors say, oh yeah, well, we try and look past that, et cetera, et cetera. But still the industry bases themselves. The first thing they're going to look at is biggest monthly drawdown. And if you've got 6.8% as a biggest monthly drawdown, they go, next, please. Oftentimes. And that's what we're trying to avoid. Like any interview, you just want to avoid making a bad impression in the first instance. So yeah, that's my pet peeve. I hate the fact that we're tied to having to produce monthly returns, but that's just the industry we're in. So I'm going to put a number of that 3.5% monthly drawdown, peak to trough, keep it below 10%. Again, like a little bit of flexibility there, but if you've got a peak to trough drawdown of 25%, so think about this from the investor's perspective. He expects the worst. He thinks to himself, okay, it's Murphy's Law, Sod's Law altogether. If I give this guy some money, the worst thing's going to happen straight away, and he goes immediately into a drawdown. So, and he looks at your peak to trough and he thinks, okay, if that happens, this guy could lose 25% of the money. And that to me is just too much. I can't risk that. That could cost me my job, blah, blah, blah. I'm not going to give him any money. So that's the way the investor is thinking. And I think that's the way you have to think as well. So think about it from the investor's perspective. He's not going to want to risk 25% of his cash. So keep that peak to trough drawdown as manageable as you can. And look at it, we know it's manageable. You just reduce your risk. As you go into drawdown, you just have to recognize it and reduce your risk. Again, so we looked at a peak to trough of 10% and a recovery of 4 months. So I think that's quite, you're still in the game. If you're showing these sort of numbers, I think you remain moderately attractive. In order to attract the big money, I think you're probably looking at a monthly drawdown of 0. In other words, you never have a losing month. Basically you don't have a peak to trough because your equity just keeps going up all the time because you're steady. So the super traders, that's what they do. They just really don't lose much money. So again, the recovery time 4 months. Now, so if you think you're this type of trader, then the place for you could well be the Trader Challenge, the FP trade. And FP is the first broker I believe, to sign up to host the Hedge Fund Trader Challenge. And I know Chris is going to come on at the end of this webinar and give you a bit more information on that. So so just a little bit of information on that. That is the prizes as such. So it's an asset manager is basically offering allocations and possibly jobs to the right client who comes along. So I can give you a little bit of insight because I know the asset manager and I know the types of traders he's after. And and he knows, because he will be able to raise money from investors for the types of traders. So he knows exactly the type of trader that he wants. So a monthly drawdown, I would say, of about 2 to 2.5% would be the optimal to impress this particular investor. And he likes traders who are able to, once they're on a good trade, to maximize profit. So in other words, the willingness to take on risk. Now that is not necessarily something we can quantify in a particular number, but there will be days. I know that the Trader Challenge runs for 3 months. There will be days in there when you just pick the market. It's almost as if you decide when the market's going to turn. You tell it. We've all had those sort of days when you're really on form, and the ability to maximize profits on those days. So if you have that and are able to show it, I think you might be well on the way to impressing this particular investor. So anyway, that's the Trader Challenge. Chris will be back at the end, I think, of this webinar, and he'll give you a little bit more information on that. Now, very important, this one. So sorry if I'm dragging on here a bit, but this is a very important one. So the notional performance on your account. So let's look at an example here. So this is very typical. You've got a $10,000 account and you've made an annual profit of $6,000, and you're going to tell me that you've made a 60% return. I'm going to say boulder dash. No, you haven't. Let's look at your average position size. You were trading on average, and this is actually an example that I took. I mean, I've changed around a little bit, just averaged it out, but it's very close to the truth. Average position size of about 1.5 lots. So that was trading. You were taking probably 6 to 8 trades a day. So trading a lot, taking 1.5 lots, and oftentimes you built up positions, and you could well have been in profit at the time, so it made sense, to a maximum total position size of 7.5 lots. Now, this is what we're interested in. We're interested in 2 things: the maximum total position size and the amount of capital that was actually at risk when you had that position. Now, in this case, and I've done a little bit of, again, I just played around with the numbers a little bit, but generally speaking, you will have access to some leverage when you're managing an investor's account. It will be of the order of 2 or 3 to 1. It may get up to 5 to 1. In some cases, it can go to 10 to 1, but generally speaking, let's call it, you're typically speaking of a 2 or 3 to 1 leverage access. If somebody gives you an allocation of $10 million, you can probably trade up to $30 million in total. That's typical. So in this case, we look at the maximum total position size of 7.5 lots. We're giving you a leverage allocation of 3 to 1. So that implies that your notional account size was $250,000. You were trading this account like a $250,000 account. I don't care what number is in the account. That 10,000 at the top is pretty irrelevant to me as analyzing your data. What I want to see is what you are trading that account like. And you are trading this account like a notional account of 250 grand, and your percentage annual return was 2.4%. So you didn't make 60%, you made 2.4%. And you did it in a very highly volatile and risky fashion, and you are most likely not going to be overly attractive to an investor. So remember, this is a prop trader type who is delivering a 2.4% return for probably a lot of noise and a lot of swings, and it's probably not worth the pain for the investor. Let's look at example number 2, a $50,000 account. Again, a total annual profit of $6,000, and we're going to, we say, so what does that equate as? So this guy's average position size of 0.2 lots. So in other words, he's actually trading, his lot size is less than his actual account size, but his maximum total position was 1.5 lots. And again, using the same 3 to 1 leverage as in the previous example, and that gave us a notional account size in this example of 50,000. Exactly the same. So in other words, he was trading this account exactly like a $50,000 account. He made a $6,000 return, and that percentage annualized at 12%. This guy's attractive. This guy immediately ticks a lot of boxes, and volatility returns low, and definitely the question is then, is this strategy scalable? And that's something we can test then by making him an allocation. So Notional 1, much more interesting to the investor than Notional 2 in this case. So moving on, we're running out of time, so we'll have to run through these. So there are some absolute no-nos, and I'm going to stress this very, very, very heavily. I don't know, I want to be careful about how I say this, but remember, if you are applying to get an allocation from an investor, this is a financial transaction. You are presenting yourself as something, a trader of talent or of note, and you are presenting your track record to back this up. Now, just make sure that your track record is authentic. That's all I will say, because you can get yourself in a lot of trouble if it's not. So if you had been trading multiple accounts, declare them all. Oftentimes, I know you think, I can't show that account because my dog had died and I was sick, and it's not a true indication of how I trade, etc., etc. You'd be surprised what the investor wants to see. You really will be. So the investor will want to see that you have some talent, for sure. But he will also want to see that you've, particularly if you're a young trader, that you have learned from your mistakes and that you have, earned your spurs, and that that you've now sort of and settled into what you do. So don't presume that you have to hide this information, right? I touched on this earlier, realized and unrealized losses. They're both relevant. They both need to be declared. So your mark-to-market return is what the investor is interested in. So you must declare both realized and unrealized losses. Monthly drawdowns of over 10% on that notional scale that we just looked at. Don't go there. I can't sell you. Simple as that. So if you turn up, I don't care who you are, what you've got, but if you're showing monthly drawdowns of more than 10%, investors are just going to go, sorry, no thanks. You may, in the retail space, find certain investors who will still go with you if you have the ability to, make that back relatively quickly. But still, I would say a no. Don't go over 10%. If you get to 8.3%. Take a holiday, stop trading for the month. And peak to trough over 6 months. Anything more than that, investors just say, look, life's too short. I don't want to have to wait that length of time to get my money back. So keep it less than 6 months. So they're the no-nos. So now we're going to look at the exciting stuff. So these are the types of prop traders who are out there at the moment. So the big asset managers, they're not as prevalent as they used to be. Sort of they're still out there, the Tigers and the Caxtons and the Brevin Howards and what have you, and their bigger prop traders will probably be managing $500 million. And I may have told you this before, but just as an aside, as a little bit of interest, I know one of these guys, and he's quite an active intraday trader, trades euro and dollar yen primarily, often just through the London Open is his preferred time to trade. So he's trading directly with one of, if not the biggest bank. And he gets like I just said, his average trade size is 200 million, and his typical spread is, I think, 0.6 pips on 200 million. I couldn't believe it. I said, surely that must be a sort of a loss leader for the bank or whatever. But I think they just, wash it all through these dark pools or whatever it is they run. And yeah, it's quite amazing the depth of the market at times. So yeah, by the way, forgive me if I'm talking just exclusively about the foreign exchange market, but that's primarily where we tend to operate, with a little bit of a focus on global macro, as I said. So the top prop traders, you'll be managing 500 million assets, AUM, by the way, assets under management. And remember, you're getting a percentage fee. If you're getting 2 and 20, even if you're only getting 1 and 15, 1% management and 15% profits. It's still, you're making quite a lot of money. You're returning on average 8% per annum. Monthly drawdowns probably keeping, I said 0.4, 0.5%. Peak to trough of 2.5% and a recovery of 2 months. So pretty impressive profile there. And that's why there are probably less than 10 maybe of these prop trade, the non-systematic ones. Now we know there's lots of algos out there, and individual algos, if we can call them like that. But for a prop trader, there's not that many. There may be 10, I would say. It could be a few more than that, but it's probably not. So that's the very top of the game if you can get to that stage. So there you go, 8% per annum doesn't sound like much, but on a $500 million allocation, it takes a fair bit of work. So that's the prop traders. The fund managers, obviously, all the big names out there. They've probably got 10 to 20 billion. Even the global macro guys will have sort of 10 to 15 billion assets under management. Generally speaking, almost exclusively they're multi-manager strategies because that's just too much money for one manager to run. The return average, they've just got to beat, the interest rate market really in a lot of cases. So 5% per annum. So just on an aside here, the alternative space, which is where we would sit in, generally will attract around about 1 to 1.3% of liquid assets that are invested. And that, again, probably doesn't sound like much, but it's I don't know how many trillion it is. It's a heck of a lot of money. So that's why these fund managers can attract such large amounts. Return average 5% per annum. Again, it doesn't sound like much, but yeah, you just got to be steady. Monthly drawdowns less than 0.3 and a peak to trough of 5%. 4-month recovery. So that's your top fund manager profile. And if you get to there, I hope I know you when you get there. So moving on, I think we're nearly done, so that's good. We're just coming up to the buzzer here. So the ideal candidate, so the people who I think are most likely to make this leap from the from the retail space into the funds management space. Now remember, obviously you've got to be able to fulfill those parameters we looked at earlier, whether you're a prop trader or a fund manager. Young at heart. There's nothing, you can't beat it. So you've got to be young at heart, enthusiastic and passionate. That's just non-negotiable. You must be, I believe, at least in some parts, systematic. And I would say your risk management processes should be 100% systematic. You cannot be just changing your mind on the size of trades you take willy-nilly just because you feel like it. Investors want to see that systematized, I think. Then you need to have one of two skills. You need to be able to make a steady profit or make an exceptional profit, one or the other. And in my own case, the really interesting guys are the guys who just, when they're on, and it may only be like for a short period every month or every 3 months, but they have the ability to make exceptional amounts of money. Make the mistakes on your own capital. And that's something that investors really like to see. So like I said, don't be afraid to show your mistakes. Everybody's made them. Just show that you made them on your own capital and you've learned from them. So I think that pretty much does it from me for today. I'm going to hand you back to Chris. He's going to tell you a little bit more about the FP Markets Trader Challenge, which is due to start in about 10 days' time, and running for 3 months. And there's some excellent opportunities available there, particularly to the prop traders out there who feel they may have those some of those skills that we were talking about earlier. So again, thank you very much for your time. And if you've got any questions, I think it's probably best if you pop them. I think Chris is going to give you a way of either popping them on an email or something, and I can answer. I certainly will answer questions in if you have any. So thanks for your time, and here's Chris.
Thanks for that, Shawn. It was a really good insight into the performance metrics in the FX industry. Now, as Shawn mentioned, we are running a Traders Challenge, and that's in association with FXWW. and Camel Asset Management. Now, FP Markets is a host broker for the challenge. And like Shawn said, there is an opportunity for a potential capital allocation and also a job with Camel Global Markets. Now, successful traders will be offered a position and an allocation up to $500,000 US. Now, the link for Camel Global Markets is in front of you on your screen. If you'd like some more information about the fund itself, you can follow that link. I'll also send you through an email with the details on it after this, so don't stress too much if you can't follow the link at the moment. Now, in addition to obviously the prize being a position at the hedge fund as well as a capital allocation, for all FP Markets clients will also be running additional prizes to supplement this. Now, this will be based off a leaderboard with FX Blue. You'll be able to monitor your position on the leaderboard globally against other brokers and other contestants. Now, the first place will be a 3-month subscription to Thomson Reuters Icon and a 6-month subscription to the chat room and $600 in free commission for the month. Now, the second place will be a 3-month subscription to Thomson Reuters Icon and 3 months to the Thomson Reuters chat room. And the third place will be a 6-month subscription to the Thomson Reuters chat room. Now, the registration and competition dates, as Shawn outlined earlier, the registration, it started on the 6th of February, and that runs all the way up to the 19th of the 3rd. So it'll be about 3 weeks after the start date. You can still join in. The competition itself will run from the 26th of the 2nd to the 26th of the 5th. So 3 months duration that you have a chance to prove yourself as a trader. Now, in terms of the terms and conditions, now I'll briefly give you an outline on what the conditions are for the competition. What you can do, however, is email myself if you want a full copy, and I can send those through to you. So to give you a rough outline, we'd be looking at a minimum starting balance of US $3,000 for the live account. We're going to set a maximum leverage of 50 to 1. There's only one account per person during the period of the competition and no rejoining or refunding. Account withdrawals are permitted during the competition period, and use of prop automated trading systems and discretionary EAs as well as trading signals is also permitted. Now, all competition accounts are on equivalent spreads, and like I said, there will be a leaderboard where you can monitor your progress. Now, to sign up, you can follow this link on your screen here. I'll also place that in the chat if you want to go ahead and follow that link. But like I said, there will be a follow-up email. In the follow-up email, there'll be the terms and conditions, the sign-up link, and a video with Shawn and the head of Camel Global Markets discussing what it is that makes a good trader. Now, everyone, thank you for attending tonight's webinar. Like I said, if you do have any questions, feel free to email myself at c.mar@fpmarkets.com.au. I'll leave this up here for you, and I will also post the sign up link in the chat. If you do have questions, feel free to send them through to c.mar@fpmarkets.com.au. Thank you all for attending tonight, and I hope to see you all at the next webinar. Thank you.